New York's real estate market is undergoing a dramatic shift in 2025. Once known for soaring home prices and intense housing demand, the state is now experiencing its steepest housing market downturn since the Great Recession. From the Hudson Valley and Long Island to Buffalo and Brooklyn, buyers are pulling back as mortgage rates rise, insurance costs spike, and longtime residents relocate in search of affordability. Investor activity has dried up, bidding wars have disappeared, and overall market confidence has plunged. In this video, Housing Watch breaks down the 10 New York cities with the fastest falling home prices and explains what this real estate decline means for the broader U.S. housing market. Subscribe to stay ahead of what's coming next. Number 10. Albany. Albany housing market decline, New York real estate trends, and falling home prices in 2025 are now reshaping the city, once known for its rock-solid stability. Albany, the political heart of New York, long offered predictable prices and steady demand fueled by dependable state government jobs. But in 2025, even this traditionally resilient market is showing clear signs of weakening. Recent housing data reveals a nearly 9% drop in median home prices across the Albany metro area compared to last summer. Inventory has nearly doubled, and homes that once sold in under 2 weeks now linger on the market for more than 40 days. The slowdown is steady rather than dramatic, but it's affecting every neighborhood, from historic downtown streets to suburbs like Colony and Clifton Park. Rising property taxes are pushing monthly payments beyond what many first-time buyers can afford. Insurance premiums are climbing as climate risk models shift, adding pressure even in inland regions. Meanwhile, wage growth in the public sector has stalled, and ongoing hiring freezes have left many residents uncertain about future income. Developers who overbuilt during the pandemic boom are now holding unsold units. Apartment conversions expected to lease instantly are sitting vacant for months, and investors known for seeking Albany's dependable returns are hesitating for the first time in years. Experts call this a soft correction, not a collapse. But buyer psychology has flipped. Buyers are waiting, sellers are negotiating, and lenders are tightening standards. For decades, Albany seemed shielded by government stability. In 2025, that safety net feels thinner than ever, proving that even the most reliable housing markets can quietly shift beneath your feet. Number 9. Rochester. Rochester's housing market decline, New York real estate trends, and falling home prices in 2025 are now at the center of the conversation, and for good reason. Once considered the quiet success story of upstate New York, Rochester long offered a rare mix of affordability, stability, and quality of life. Families moved here for lower home prices, reliable jobs, and a calmer pace compared to downstate. But in 2025, that stability is slipping. New data from leading real estate analytics firms shows Rochester's home values cooling for the first time since the pandemic boom. The median home price hovers around $230,000, a slowdown that hints at deeper weakness beneath the surface. Listings that once vanished in days are now sitting for weeks. Sellers are cutting prices, and the competitive frenzy has given way to caution. High mortgage rates continue to keep monthly payments out of reach for many local buyers, while heavy property taxes and stagnant wage growth add more pressure. Even Rochester's economic pillars, healthcare, higher education, and optics manufacturing, are feeling the strain of inflation and selective hiring freezes. Builders who expanded aggressively during the pandemic are now struggling to move inventory, offering incentives like closing cost credits and upgraded finishes in towns such as Greece, Irondequoit, and Webster. Rising energy bills, higher insurance premiums, and growing maintenance costs are squeezing long-time residents as well. And for younger buyers hoping to escape expensive downstate markets, Rochester no longer looks like the guaranteed safe haven it once was. Still, experts emphasize that this is not a crash, it's a recalibration. After years of unsustainable growth, the market is moving toward healthier balance. For buyers with patience, strong finances, and long-term plans, real opportunity remains. But Rochester's shift in 2025 is a reminder that even the most dependable housing markets can change quickly, and no market stays stable forever. Number 8. Queens. Queens housing market decline, New York real estate downturn, and falling home prices in 2025 are redefining the borough that once symbolized affordability and opportunity. For decades, Queens served as the bridge between New York City's ambition and its attainable cost of living. A place where working families, first-time buyers, and new immigrants could build a future. But in 2025, that balance is breaking as the borough's housing market faces real pressure. Median home prices have dropped nearly 12% year over year, according to data from Zillow and StreetEasy. Inventory has surged to its highest level since 2015, and homes that once drew offers within days are now sitting on the market for months. Neighborhoods like Forest Hills, Astoria, and Flushing, long considered insulated from downturns, are seeing price cuts of $50,000 to $80,000 per listing. The luxury condo boom in Long Island City has stalled as buyers abandon pre-construction contracts, forcing developers to roll out steep discounts and incentives. Economic headwinds are compounding the slowdown. Mortgage rates remain elevated, while insurance and maintenance costs for co-ops and condos have jumped sharply. After years of steady population growth, Queens is now losing residents to more affordable regions such as New Jersey, Pennsylvania, and the Carolinas. Even the rental market, traditionally Queens' safety net, is softening. Landlords in Ridgewood and Jackson Heights are reporting longer vacancies, slimmer margins, and more frequent price reductions. Queens' diversity and proximity to Manhattan remain valuable strengths, but rising costs and declining confidence are taking a toll. The middle class that once anchored the borough is being priced out, and investors are pulling back. Queens has overcome downturns before, and it will again. But in 2025, the path to recovery may be longer than anyone expected. Number 7. Yonkers, just north of New York City. Yonkers once represented an attainable alternative to Manhattan living. For years, its appeal rested on a simple equation: live in Yonkers, commute to the city, and enjoy urban access without Manhattan's steep costs. That formula is breaking down in 2025. Office attendance across the New York metro area remains below 60%, and hybrid work has permanently altered the commuter belt economy. Ironically, the proximity that once defined Yonkers' advantage is now a liability. Homeowners who relied on steady demand from Manhattan workers are seeing that demand fade. Across Westchester County, price reductions of 15 to 20% have become common. Condos and brownstones that once sparked bidding wars now sit on the market for months. Even luxury towers overlooking the Hudson River are offering rent-to-own deals, an uncommon strategy in what was once one of the region's most competitive markets. Developers who rushed to build high-end units during the pandemic boom are struggling to fill them. High homeowners association fees, rising maintenance costs, and elevated property taxes further discourage buyers. At the same time, affordability has eroded for middle-class families, leaving Yonkers caught between an oversupply of luxury housing and a shrinking pool of qualified demand. The city is also facing an identity crisis. Once marketed as the next Brooklyn, Yonkers promised creative energy, and waterfront revival. But as urban migration slows and interest rates remain high, that narrative is losing traction. Investors, wary of high carrying costs and longer resale timelines, are pulling back. Still, Yonkers retains real strengths: transit access, diverse neighborhoods, and a strategic location. Recovery is possible, but the lesson is clear. When the economic center shifts away from the office, commuter cities must adapt. In 2025, Yonkers is no longer chasing the Manhattan dream. It is searching for a new one of its own. Number 6. Long Island. For decades, Long Island embodied the American dream within reach of New York City. Tree-lined neighborhoods, strong public schools, coastal access, and a sense of prestige made it one of the most desirable suburban markets in the country. In 2025, however, that image is beginning to fracture, and the shift is accelerating faster than many expected. Across Nassau and Suffolk counties, housing inventory has surged by as much as 85% compared with 2023. Homes that once attracted multiple offers within days are now sitting unsold for months. Regional market data shows median home prices have fallen roughly 17% in less than 2 years, marking one of the sharpest corrections in the area's modern history. The pressures driving the slowdown are significant. Property taxes remain among the highest in the nation, averaging more than $12,000 annually, pushing many families to relocate to lower-cost states such as the Carolinas, Georgia, and Florida. Insurance costs have compounded the problem. Premiums have doubled for many homeowners, particularly in coastal communities like Freeport, Babylon, and Lindenhurst, where flood risk reassessments have caused major insurers to pull out. Those who stay are often forced into state-backed plans with higher costs and reduced coverage. Even traditionally insulated markets are feeling the impact. In the Hamptons, luxury homes that once sold above asking price now linger through entire seasons. Investor demand has cooled, and rental activity has softened as high-end buyers wait for clearer market signals. For middle-class families, the equation no longer works. Elevated mortgage rates, relentless taxes, and rising maintenance costs have eroded affordability. Long Island still offers natural beauty, beaches, vineyards, and proximity to Manhattan, but the affordability that sustained its growth has disappeared. This is no rumor. It is a correction unfolding across the island, proving that even prestige cannot defy economic gravity. Number 5. Binghamton. Binghamton was once a quiet comeback story in upstate New York, a city that endured the loss of manufacturing and rebuilt itself around healthcare, education, and relatively affordable housing. For several years, that combination attracted new residents and investors looking for value. But in 2025, Binghamton's affordability advantage is eroding, and the housing market is slowing in ways locals have not experienced in years. According to data from Redfin and Zillow, median home prices in Broome County are down roughly 10% year over year, while housing inventory has surged more than 60% compared with 2023. Homes that once sold within days now linger on the market for 2 to 3 months. Even stable suburban areas such as Vestal and Chenango are seeing frequent price cuts. The slowdown traces back to the pandemic-era buying surge, when remote workers from New Jersey and Pennsylvania pushed prices up rapidly. Binghamton was viewed as a low-cost alternative to the crowded Northeast Corridor. However, as mortgage rates climbed and remote work opportunities declined, demand fell sharply. Buyers who entered at peak prices are now watching their home equity shrink. At the same time, property taxes remain high, and maintenance costs have risen as inflation drives up expenses for heating, insurance, and repairs. With the local economy still transitioning and wage growth lagging behind costs, many households are feeling increasing financial pressure. The rental market is offering little relief. Investors who purchased multifamily properties during the boom are facing higher insurance premiums, slower rent growth, and rising vacancies, particularly downtown. Landlords are beginning to offer concessions to attract tenants. City leaders hoped Binghamton's university presence and affordability would stabilize demand. Instead, the market has entered a post-boom reset as prices search for a sustainable balance. Binghamton's resilience remains, but in 2025, it is being tested once again. Number 4. Buffalo. Over the past decade, Buffalo has worked hard to rewrite its narrative. Once emblematic of Rust Belt decline, the city emerged as a national example of revitalization, driven by affordability, reinvestment, and strong community pride. That momentum has not disappeared, but in 2025, Buffalo's housing market is clearly cooling under new economic pressures. Recent housing data shows median home prices down roughly 10% year over year, while sales volume has fallen by nearly 1/3. Homes that once sparked bidding wars are now sitting on the market for 70 days or more. This is not a crisis, but it marks the first meaningful slowdown since Buffalo's comeback began. Affordability erosion is a major factor. Mortgage rates hovering near 7% have priced out many first-time buyers, while Buffalo's utility costs, among the highest in the Northeast, are cutting deeply into household budgets. Long winters mean heating bills that can reach hundreds of dollars per month, reshaping buyer preferences and dampening enthusiasm. Investors are also pulling back. Many who once targeted Buffalo for low-cost rental properties are quietly exiting as returns narrow. Rent growth has flattened, while maintenance, insurance, and repair costs continue to climb. Even traditionally stable suburbs such as Amherst, Tonawanda, and Cheektowaga are seeing price cuts on listings that previously sold almost immediately. Despite the slowdown, Buffalo's fundamentals remain intact. The medical corridor continues to expand, downtown waterfront development remains active, and community investment has not stalled. What has changed is sentiment. Buyers are cautious, and sellers are adjusting to the reality that the rapid appreciation of the past decade was not sustainable. Buffalo is not collapsing, it is recalibrating. After years of optimism and growth, the market is catching its breath, adapting to inflation, rising costs, and shifting economic conditions. The Renaissance is still there, but in 2025, its glow is noticeably dimmer. Number 3. Staten Island. Staten Island has long been New York City's quiet borough. Suburban, stable, and slightly removed from the intensity across the harbor. For decades, it offered something rare, the promise of affordable homeownership within reach of Manhattan. In 2025, however, that promise is fading, and Staten Island has become one of the clearest examples of the city's housing correction. According to regional sales data, home prices across the borough are down roughly 14% year over year. Closed transactions have fallen to their lowest level since 2015, and listings that once vanished within weeks are now lingering for months. From Tottenville to St. George, price cuts are no longer the exception, but the norm. Isolation is a major driver of the slowdown. As remote and hybrid work become permanent for many New Yorkers, the value of Staten Island's long commute has diminished. Daily travel across bridges and ferries is costly and time-consuming, with the Verrazzano Narrows Bridge toll alone adding hundreds of dollars per month for commuters. When combined with some of the highest property taxes in the city, affordability quickly disappears. Flood zone reclassifications have added further pressure. Insurance premiums have surged in coastal neighborhoods such as Midland Beach and Great Kills, where updated risk maps have pushed monthly costs up by hundreds of dollars. For many families, these increases have erased the savings that once made Staten Island attractive. Developers who expected continued demand are now sitting on unsold townhomes and condominiums. Incentives, price reductions, and mortgage rate buy-downs are increasingly common, just to attract interest. This moment represents a reckoning for Staten Island. Its appeal has always rested on stability, tree-lined streets, family homes, and quiet neighborhoods. But in 2025, even stability comes at a cost many can no longer afford. Staten Island remains one of New York City's most livable boroughs, yet its housing market has entered unfamiliar territory, and the slowdown no longer feels temporary. Number 2. Brooklyn. For years, Brooklyn has been the heartbeat of New York City's cultural and housing boom. Its mix of historic brownstones, modern high-rises, and creative energy made it one of the most sought-after urban markets in the country. In 2025, however, that momentum has slowed. The borough, once defined by relentless growth, is now facing its sharpest housing correction in more than a decade. According to local MLS data and Redfin reports, median sale prices in Brooklyn are down more than 18% year over year. Inventory has climbed rapidly, and open houses that once drew crowds now attract only a handful of cautious buyers. In neighborhoods such as Williamsburg, Park Slope, and Prospect Heights, listings are sitting unsold for months despite repeated price reductions. The forces behind the slowdown are both financial and behavioral. Mortgage rates near 7% have frozen many buyers on the sidelines. Rent growth has flattened, bringing an end to the investor-driven surge that once fueled demand. At the same time, remote and hybrid work have reduced the need to live in dense urban centers. Thousands of former Brooklyn residents have opted for more space and lower costs in New Jersey, Pennsylvania, and upstate New York. Investors who once viewed Brooklyn as a guaranteed win are also retreating. Tighter rent regulations, soaring maintenance and co-op fees, and rising operating costs have squeezed profit margins. Smaller landlords, who bought at peak prices during the pandemic, are now struggling to sell without taking losses. Luxury development has lost momentum as well. New condominium towers in Dumbo and downtown Brooklyn are offering significant incentives, including large closing credits, as demand for ultra-expensive units fades. Brooklyn remains deeply appealing. The brownstone streets of Carroll Gardens, the skyline views near the Navy Yard, and the creative pulse of Bushwick still define its identity. But the economics have shifted. This is not a collapse, but a prolonged reset. In 2025, Brooklyn's dream endures, yet for many, the cost of holding on to it has become too high. Number 1. Manhattan. For generations, Manhattan has symbolized global wealth and American ambition. This island defined real estate success, a market where prices seemed to rise endlessly and scarcity alone created value. In 2025, that myth is being challenged. After a brief rebound from pandemic-era lows, Manhattan is facing another major housing correction. According to data from StreetEasy and Zillow, median home prices have fallen nearly 20% since 2023, marking one of the steepest declines in more than a decade. The luxury segment, once the engine of Manhattan's growth, is now driving the downturn. With mortgage rates still hovering near 7%, the monthly payment on a $1 million apartment can exceed $8,000 before taxes and maintenance fees. The result is fewer qualified buyers, longer listing times, and deeper price cuts. Housing inventory has surged more than 50% year over year. Open houses in Soho, Tribeca, and the Upper East Side now draw a fraction of the traffic they once did. International demand has also weakened. Capital flows from Asia, Europe, and the Middle East have slowed as global economic conditions tighten. Foreign buyers who once treated Manhattan condos as a store of value are stepping back, leaving entire developments struggling to close sales. Even the rental market, long considered untouchable, is showing signs of strain. Thousands of high-end units completed between 2020 and 2023 remain vacant. Landlords are offering steep concessions, including multiple months of free rent, as average rents begin to slide from their recent peaks above $5,000. Office vacancies are compounding the problem. As hybrid work becomes permanent, half-empty towers are draining energy from surrounding neighborhoods and weakening demand for nearby housing. Manhattan's skyline still shines, but beneath it, the numbers tell a sobering story. In 2025, even the world's most iconic housing market is confronting gravity, signaling that the correction is no longer isolated. It is here. It is not just a dip. It is a recalibration, driven by affordability pressures, shifting migration patterns, and economic fatigue. Homeowners are adjusting expectations, investors are retreating, and buyers are waiting for clarity. Subscribe to Housing Watch for more cinematic, data-driven explorations of America's changing housing landscape. Because in 2025, the housing crash is not a headline. It is a reality, and it is spreading one city at a time.